All right, thank you very much, Rick Santelli. Let's turn to the equity markets. Value stocks are greatly underperforming growth names. Since the recent market bottom on April 8th, the Russell Growth Index has outperformed the Russell Value Index by more than 20 percentage points in just the past 4 months. So how are value investors supposed to survive in this hot, growth-driven market rally? I heard it described as growthy. I thought that was really great. Joining us on set to discuss is Grisanti, the chief market strategist at MAI Capital Management. Chris, when we talk about value investors, my first question is, should anybody be just a value investor right now?
Sure. Well, you define broadly, value investing is going where stocks are cheaper than they ought to be. And I think every investor wants that,
right,
of course, and then we argue about what that means. But to be a real value investor now, you have to hold two kind of conflicting ideas in your mind at the same time. One is that a lot of stocks are dangerously expensive, and I think it's easy for value investors to hold that in their minds. But the second thing is there are factors at work right now that mean I think this market goes higher in the near to intermediate term. And these factors are technical, but they're also fundamental. So my biggest one that I don't think enough people are focusing on is the CapEx by the four big tech companies is going to be about $400 billion in 1 year. That used to be, you guys remember, that would be the size of a stimulus package that Congress might pass in order to stimulate the economy. So you can't stand in the way in that. You can't be a value investor and say, oh, the market's too expensive, I'm not going to invest, because there's just so much of a tailwind with this stimulus-like CapEx. And there's a number of other earnings things, too, that you've got to play in the game.
Okay, so given the CapEx spending from the likes of Meta, Amazon, Google, and Microsoft, where can you put your money and expect to see some growth in a value play?
But you got to stay a value investor. So what I want you to do is go to those sectors that have, the tide is out, like in healthcare be my favorite one, because now healthcare is the lowest percentage of the S&P since the early 90s. So 35 years ago, it was this low and never again. So what we're looking for there is companies with good balance sheets, good earnings.
And you can see we're showing health insurance investing. You're hot on health insurance as opposed to healthcare?
No, I like all of healthcare, but I have a special place in my heart as a true value investor for health insurance. So just last week, the Wall Street Journal had an article that said, are these health insurers just uninvestable? And when you start reading stuff like that, you think, that's where I want to go as a value investor, because, of course, these are huge multi-billion-dollar companies. They're not uninvestable. They'll get back on their feet, and they're selling at near record low valuations.
Is there a difference? Back in my mutual fund days, they called it GARP, right?
Sure.
Growth at a reasonable price.
Mm-hmm.
What's the difference between a GARP-type trade and pure value investing, other than that you're combining more factors into that GARP
there's
model?
a big intersection of the Venn diagram, but real value investing, we don't care quite as much for growth. For example, Dom, Pfizer and Merck are two pharmas. They're not growing very much at all, so it's not GARPy, but they're so darn cheap. So they're selling at sub 10, 8, 9 times earnings. They have yields of 4, 5, 7% for Pfizer. And all they need to do is hit 1 or 2 good drugs. We can sit there and clip the coupons while we wait. Or if the market turns over like it did in the first quarter, these stocks were the best performers of the entire market. So that's where we go.
Well, what's a value trap then? How do you avoid that when you say, hey, this is so cheap, but it stays that way for a long time?
Sure. So that separates the men from the boys, as they used to say. So I think what you do there is you find, are the cash flows good? Are the balance sheets good? And the value traps only kill you if they really go down. So what you want, the dirty little secret of our business is not who gets the stocks that go up the most. That's exciting. That's good headlines. But the ones that avoid the ones that go down a ton when things get more difficult, much more difficult than they are today. And a good value investor should be able to do that.